Hello, everyone. Welcome back to the Business Broker Expert channel, where we demystify the world of buying and selling businesses. I'm Dean Wiltsey, partner and managing broker of Curtis Wiltsey, with over 20 years of experience helping entrepreneurs exit their companies on their terms. Imagine you've done it. After weeks, maybe months, of conversations, negotiations, late-night strategy calls, a serious buyer delivers a formal letter of intent. The number on that page is life-changing. It represents decades of risk, stress, sacrifice, payroll cycles, and reinvestment. And for a moment, you feel validated. Then reality sets in. The LOI is not the finish line. It's the starting pistol. Because now begins the most intense, invasive, and critical phase of selling your business. Due diligence. Today, I'm going to walk you through exactly what that means and how we help you to prepare so it doesn't derail your deal. Due diligence is the buyer verifying everything, every number, every contract, every employee, every liability. Their accountants, lawyers, and advisors now given access to your company at a level that can feel uncomfortable, even confrontational. For many owners, it feels like an interrogation. But here's the truth. Due diligence is not a trap. It's a necessary and normal part of any legitimate transaction. And when you understand it and prepare for it, it becomes a confirmation of the quality of the business you've built. Think of it this way. You've told the buyer your business is solid. Due diligence is the inspection and verification. If the foundation is strong, you close smoothly. If there are cracks, they'll find them. The three pillars of due diligence are: every transaction can be organized into three main categories: financial due diligence, legal due diligence, operational due diligence. Let's break each one down. First, financial due diligence, opening the books. This is the foundation. If the numbers don't hold up, nothing else matters. Buyers typically request 3 to 5 years of profit and loss statements, balance sheets, corporate tax returns, detailed general ledgers. They will compare everything line by line. If your tax return shows $1.2 million in net income, and your internal financials show $1.6 million, that difference needs a crystal clear explanation. Then comes something extremely important: quality of earnings, often referred to as Q of E. The buyer's accounting firm performs a forensic level review to verify your true EBITDA, earnings before interest, taxes, depreciation, amortization, or SDE, seller's discretionary earnings. This is the number the bank uses to determine if the new business can afford the debt. This is the number the purchase price is based on. And this is where deals either hold or not. Add-backs get tested. If you run personal expenses through the business, which everyone does, vehicle, travel, one-time equipment purchases, those are potential add-backs. But you must prove they're non-recurring, they're discretionary, and a new owner would not incur them. You don't get credit for "because I say so." Documentation wins. Revenue quality. Buyers request a customer revenue breakdown. They're looking for concentration risk. If one client represents 25% of revenue, that is vulnerability. They'll ask, what happens if that client leaves? The more diversified and contractually secured your revenue is, the stronger the valuation. Working capital and balance sheet. They'll review accounts receivable aging, accounts payable aging, inventory, debt, lines of credit. Old unpaid invoices are a red flag. Vendor disputes are a red flag. Unrecorded liabilities are a major red flag. This is why clean books, months or years before selling matter so much. Second is legal due diligence, under the microscope. Now the lawyers step in. Their job is simple. Ensure that there is no legal landmines the buyer inherits. That's it. Corporate structure. They will request articles of incorporation, operating agreement or bylaws, shareholder or member records, state good standing certificates. They want to confirm ownership is clear. You would be shocked how many deals get delayed because a former partner's equity was never properly documented. Contracts. Buyers will ask for customer contracts, supplier agreements, subcontractor agreements, equipment leases, real estate leases, and they're looking for one specific phrase: change of control. Some contracts require consent before transferring that contract to a new owner. If your largest contract requires approval and you haven't addressed it early, it can stall a closing. Employee classification. This is huge, especially in contracting services and healthcare industry. If you use 1099 contractors, buyers will examine whether they should be legally W-2 employees. If misclassified, that's potential back tax penalties and liability. It doesn't mean the deal dies, but it can absolutely impact price or structure. Litigation and compliance. They will search for past lawsuits, pending disputes, regulatory violations, licensing status. If there is an issue, disclose it early. Surprises kill trust, and trust drives closing. 3, operational due diligence. How it really works. Now comes the practical question. How does the business actually operate day to day? Buyers want to understand who makes decisions, who manages projects, how sales are generated, whether the owner is essential. This is owner dependency risk. If every decision flows through you, that lowers perceived stability. If you have a management team, documented standard operating procedures and systems, that increases buyer confidence dramatically. Equipment and assets. They'll review your fleet. They may physically inspect trucks or equipment. If everything is old and needs replacement, that future CapEx gets factored into the price. Key relationships. Late in due diligence, buyers may ask to speak with key customers or vendors. Handled properly, this builds confidence. Handled poorly, it creates anxiety. This is where experienced advisors protect confidentiality and manage timing. The most important lessons. Here's the takeaway. Due diligence is intense, but it's entirely manageable. The smoothest closings we've seen, whether through Curtis Wiltsey or not, are from owners who prepared long before they went to market. They cleaned up their books, they resolved legal loose ends, reduced owner dependency, documented processes, identified red flags early. The work you do before the LOI determines whether diligence is smooth or stressful. When preparation is strong, diligence becomes what it's supposed to be, a professional confirmation of the value of what you've created. And that's when the biggest transactions of your life close with confidence. If you're thinking about selling in the next 1 to 3 years, start preparing now. If you'd like a confidential readiness review, reach out to us. I'm Dean Wiltsey, Managing Director at Curtis Wiltsey, alongside with my partner, Dr. Remington Curtis, CPA. This is Business Broker Expert. And remember, windows open, windows close. Preparation determines which side you're on. Thanks for watching.